Okay, Bismillahirrahmanirrahim. Today we will let me check the first that is working or not. Okay, today is our first lecture, and that's will be for the senior auditor preparation. Clear? And this post is mostly advertised by the Federal Purchase Commission, and we will do MCQs along with the concept. Clear? First, let's talk about what is the eligibility criteria for senior auditor. So here, if you look, you see this one, second class or grade C bachelor degree in business administration, which may be in the field of finance, accounting, and commerce, economics, statistics, mathematics, or equivalent from university recognized. So you must have second class bachelor degree in the field of business administration, or you may also be eligible for these forms if you possess a bachelor degree along with ICMA 1-year postgraduate certificate or chartered accountancy CA foundation or ACCA knowledge base level qualified. So if you have this one, then you are eligible. If you have this one, then you are also eligible. Now let's talk about the paper patterns, that what will be the paper composition for this post. So the paper composition is very simple. Composed of the paper will be objective type. You must be tested for MCQs, multiple choice question. There are two parts. The first part is English and the second part is professional test. So it means that in English you will be tested for grammar usage, sentence structuring, and so on like that. While in part B, which is consists of 80 marks, the 80 marks are allocated to the professional test, which will be your subject. So and the syllabus of the part 2 will be the accounting procedure and accounting principles. Then you have a scrutiny of record of the audit purposes. Then you have general ledger, cash book, preparation of annual budget, adjustment and depreciation, financial planning and cost accounting, head of accounts, appropriation of funds and supplementary grant, settlement of audit objective, preparation of pension documents, and the last is the public procurement rule, we call as PEPRA. And so we will discuss all these subject one by one. From today we will start from this one, the accounting principle and procedure. So let's start it. Okay, the first one, accounting principle, is a general acceptable accounting principle, which we call GAAP. In most of the exam it is tested what is the full form of GAAP. So this is the generally accepted accounting principle. And what is actually GAAP is, so it's a set of accounting principle, standards and procedure that are widely accepted in United States, like IFRS, like ISA, ISA in International Accounting Standard. GAAP is also used for the preparation of financial statement. So this is GAAP is actually a set of accounting principles, standards and procedure, and these set of accounting principle and procedure are widely accepted in the United States. It provides a consistent framework for preparing the financial statement and ensure the comparability and transparency in financial reporting. So GAAP is actually a set of accounting standards, rules and procedure that companies use to prepare their financial statement. And GAAP ensure that financial statements are accurate, consistent and comparable across different companies. Let's look over here as the example. Okay, GAAP encompasses various principle and standards. For example, revenue recognition principle. If we talk about revenue recognition principle, we state that revenue should be recognized when it's earned and realizable. It means that you have to recognize the revenue when it's earned and realizable, regardless of their actual cash payment or the amount you received. So, for instance, you have a software company and that would recognize revenue from a sale when the customer has received the software license and it can be reasonably assured of the payment. So this means that you will recognize the revenue when it's earned, okay, and you have reasonable assurance that the payment will be received. So you will recognize the revenue, and this is the principle, one of the principles from the GAAP. Clear? Now let's move on. We have another accounting principle, and that is accrual basis of accounting. Under the accrual based accounting, revenue and expenses are recognized when earned or incurred, regardless of when the cash is received or paid. So this principle ensures that financial statements reflect the economic activity of a business over a given period. What does it mean? It means that revenue and expenses should be recognized when the revenue is earned and the expenses are incurred. Okay, regardless whether you have received the cash, or you have paid the cash. But you will recognize the revenue expenses when it's earned and the expenses incurred. Clear? It means that accrual base of accounting is as a method of accounting that records revenue and expenses when they are earned and incurred, regardless of when the cash is received or paid. So this method provides a more accurate picture of the company financial performance than the cash base of accounting. Let's have a look over the example. So under the accrual base, revenue expenses are recorded when it's earned and incurred, regardless of the cash flow. For example, a company provides consulting services to a client in December, but doesn't receive payment until January. Now, according to the accrual concept, the company would recognize the revenue in December when the services were provided. It says that you have a consulting, let's say you have a consulting servicing company. You are providing consulting services. Clear? Now you provided the services in December. Okay, so it means that you have earned the revenue in December. Okay, and the cash for these services you will receive in January. Okay, so the actual payment will be in January, but you have earned this in December, so you will recognize this revenue in December. This is the actual concept of the accrual base of accounting. Now let's move on. We have another and very interesting concept, that is going concern principle. Okay, according to this principle, the going concern principle assume that a business will continue to operate indefinitely unless there is evidence to the contrary. This principle allows companies to value their asset based on the long-term usefulness and to defer recognition of certain liability. Okay, according to this concept, this principle, you have to assume that the business will continue to operate. The business will continue to operate. It means that the assumption that a company will continue to operate for the foreseeable future. So this principle is important for financial statement user to assess a company ability to meet its obligation and determine its long-term viability. Now let's have an example. And the going concern principle assumes that a business will continue to operate indefinitely. For example, when a company prepares its financial statement, it doesn't assume that it will go bankrupt or cease operation in the near future unless there is evidence indicating otherwise. So it means that when you are preparing the financial statement, you are assumed that you will be continue for the foreseeable future and there is no chances of bankruptcy. You will not be bankrupt, or you don't have any intention to cease or to stop the operation. Clear? So this is the basic logic and this is the basic concept of the going concern principle. Now let's move on. We have another very interesting one, that is historical cost principle. According to this principle, assets are recorded at their original cost. You mean this, according to this concept, according to this principle, the assets are recorded at their original cost when acquired, and this cost is used as the basis for subsequent accounting, and you will use this original cost for subsequent accounting, and it doesn't take into account changes in the market value over time except under certain circumstances. It means that the principle of historical cost says that assets should be recorded at their original cost, the first thing, rather than their current market value. You have to record the asset at the historical cost, not on the current market value. Clear? And this principle provides a reliable and objective basis for valuing asset and help prevent overstatement of a company financial statement. So this will help, the historical cost principle will help it will prevent from the overstatement of the company financial statement, because you are using historical cost, not the market value. For example, if you see here, the historical cost principle states that assets should be recorded at their original. For example, a company purchased a building for this amount. Under the historical cost principle, it would be recorded the building at its original cost, this amount, regardless of the current. Let's say the current market value is $600,000. So we will use this amount, and this will be used for the subsequent measurement also. Clear? So this will prevent the financial statement, financial position of the company from overstatement. Clear? Now we have another concept that is called matching principle. The matching principle requires that expenses will be recorded in the same period. It's talking about a period as the revenue they help generated. So means that the expenses will be recorded in the same period when the revenue is generated. It means that expenses should be recorded in the same period as the revenue they help generate. So this principle ensures that the financial statement accurately reflect the company profitability by matching expenses to the revenue they help generate. Okay, if you see here the example here, if a company sell product in December, it should recognize the related cost of goods sold and other expenses in December as well. So mean you are generating revenue in December, so you have to recognize the expenses because of which you have generated this revenue should also be recognized in December. This is the matching principle concept. We have another one concept that is called materiality principle. The materiality principle states that the financial information should be presented in a way that is meaningful and relevant to user. According to this principle, the financial information should be presented in a way that is meaningful and relevant to the user. Who is the user? The stakeholder, the shareholder. An immaterial item may be omitted or aggregated to avoid unnecessary complexity. So mean you have to be omitted the immaterial or aggregate them to avoid unnecessary complexity. So the basic concept in this principle is that only significant information should be reported in the financial statement, and this principle allows companies to focus on the reporting information that is relevant and useful to the financial statement user. So you have to be care about that according to this concept you have to only provide those information or present those information which are significant and which are relevant to the user, and you have to be omit or aggregate, avoid the unnecessary complexity for the user, and those information which are not relevant for the user you should omit them. Okay, this is about the materiality concept. Let's have discuss the example. For example, a company purchases office supplies for $50. It may be considered immaterial and can be expended immediately rather than being capitalized and depreciated over time. So this is the basic concept. This is $50 is immaterial amount, and you should expense it to the profit and loss and should not be included in the balance sheet. You have not to capitalize them, and you should not be depreciated over time. So this is the basic concept of materiality. Now let's move on. We have another concept, and that is consistency principle. The consistency principle require businesses to use the same accounting methods and principle from one period to another, and this allows the comparability and ensure that financial statements are consistent and reliable. Let's say we have this one accounting period and this one accounting period. So according to this principle, you have to be consistent with the method and principle you are using in this, let's say in this period and this period, because it will be very helpful to compare these two accounting periods, and this will ensure the user will be, the comparability will be useful for the user. So according to this concept, that the company should use the same accounting method and procedure from one period to the next, and this principle ensures that financial statements are comparable over time and make it easier for the financial statement user to analyze trend. Let's have a look here an example. For example, a company chooses to use the first in first out, this is called FIFO method for inventory valuation, and it should continue using that method consistently in subsequent period. Let's say in the first accounting period you use this method, and then you said no, let me use this one. So the comparability of these two methods is not useful. You have to use the both method same. So if you're using the both methods same, you are consistent with your policy, you are consistent with your principle, your method, then it will be useful for the user to compare. Now let's discuss the full disclosure principle. The full disclosure principle is basically the principle that all material information should be disclosed in the financial statement. The full disclosure principle mandates that inclusion of all relevant information that may affect the interpretation of financial statement, and this includes explanatory notes, supplementary schedules, and other disclosure necessary to complete understanding of the financial position and performance of the business. It means that all material information that are that are relevant should be disclosed in the financial statement. So this principle ensure that the user have access to all the relevant information about the company financial position and performance. If you see here the example, the full disclosure principle requires business to provide all relevant information that may affect the interpretation of financial statement. For example, a company may include detailed footnotes in its financial statement to disclose significant accounting policy, contingent liability, related party transaction. So accounting procedure involve, now let's talk about accounting procedure. So accounting procedure involve a specific step and guideline. These are the guideline and steps followed to implement accounting principle. Means these accounting procedures are actually a specific step and guideline followed to, we are following these guidelines followed to implement accounting principle. To implement the above principle, we are using accounting procedure, and these procedures may vary in organization, but they generally include process such as recording transaction, preparing financial statement, reconciling account, conducting audit, and complying with the regulatory requirement. So we have studied the principle, and these to implement these principle we are using accounting principle and guidelines. And for example, this is include the process include like recording transaction, and this recording transaction, preparing for statement, reconcile. So let's talk. We have just finished the accounting principle and procedure. Now let's go to the MCQs. We'll discuss the MCQs and then we'll wrap up. Here is the MCQs. For example, the first MCQs is generally accepted accounting principle. The first one MCQs will be related to the general accounting principle. Which accounting principle state that the revenue should be recognized when acts on and realizable? So according to accrual concept, you have to recognize the revenue and expenses when the revenue when you earn the revenue, and expenses when you anchor the expenses should be recognized in the period and that in the time when you earn or anchor, regardless of their actual cash flow. So the first MCQs is accrual basic of accounting. Which accounting principle require business to include all relevant information that may affect the interpretation of financial statement? Which accounting principle require business to include all relevant information that affect interpretation of? So that one is full disclosure principle. You have to disclose all those information which are material information and should be disclosed in a financial statement. So this is the second MCQs. Let's move on. We have another MCQs, and that is under the accrual base of accounting, when should expense be recognized? So the expense should be recognized when they are anchored. So the option A is the correct. And I have told you before, revenue should be recognized when it's on, and expenses should be recognized when at anchor, regardless of the cash flow. Regardless of the cash flow. The accrual base of accounting records revenue when it's on and realizable. When it's on and realizable. So accrual based accounting records revenue when you earn the revenue, regardless of the actual cash flow. Now let's have a question on going concern. So going concern must assume that a business will continue operation indefinitely. Indefinitely means for foreseeable future. You are continuing your business. You are assuming that you are not in a position. You are not. You don't have intention to cease your operation. You don't have intention. You don't. You will be not bankrupt in the near future. So this is the going concern concept. The going concept is allow businesses to value their asset based on the long-term usefulness, because we are thinking that we are not be bankrupt in the future, and we don't have intention to cease up our business, so we value our asset based on the long-term usefulness. Okay, according to historical cost principle, assets are recorded at original cost when acquired, and subsequently also we measure the asset at original cost. We are not using market value, and this will help to prevent the financial statement from overstatement. Okay, so according to historical cost principle, the assets should be recorded at original cost when acquired. Clear? The historical principle doesn't take into account changes in the market value over time, because we are recording the asset at original cost, so we are not taking changes in the market value over time. The matching principle requires that expenses be recognized in the same period as revenue generation. The expenses should be recorded in the period at the period when you generate the revenue in the period. So I mean, this is actually the concept that expenses should be recorded in the same period as the revenues they help generate. So revenue generation, expense record and expense recognized in the same period is the revenue generation. The matching principle helps to ensure that financial statements accurately reflect costs associated with generating revenue. The same concept, costs associated with generating revenue. Now the materiality principle states that financial information should be presented in a way that is relevant and significant. You have not to be used the immaterial and irrelevant stuff. You have only present the financial information that are relevant and significant for the user. The materiality principle allows businesses to omit immaterial item from the financial statement, because according to that concept we have to use relevant and significant information. Now the consistency principle requires business to use same accounting method and principle across different accounting period. You have to use the same principle. Let's say the example was first in, first out, so you should also use first in, first out method of inventory valuation and the two different accounting periods, so it will be easy for comparability. The consistency principle enhance what? The comparability and the reliability of financial information, because if you are using the same accounting method of inventory valuation, then that will be easy for comparability, and it will be enhance the reliability of the financial statement. And the last is the full disclosure principle. So the full disclosure principle mandates the inclusion of all relevant information. According to this full disclosure principle, you have to include all the relevant information, okay, and you have to ensure that financial statement user have access to all the relevant information about a company's financial position and performance. The full disclosure principle is aimed at providing the user of the financial statement with a comprehensive understanding of the business composition. So this is all about the first accounting principle discussion, and then MCQs related to that topic. Okay, thank you for watching this video. Inshallah, we will continue our this course. So keep watching. Thank you.